Hello, Management 6133 students. This is your week 3 lecture, and it will cover the accounting processes. So one thing to keep in mind when we're talking about processes, the 3 major processes of buying, making, and selling, is that we have to understand each of these processes have financial consequences. And accounting records these financial consequences and then takes this information to plan and manage other processes. So we'll be looking at the difference between financial and management accounting. We'll be looking at the data that needs to be set up in SAP before we start doing these processes. Then we'll be looking at the different accounting processes and the reports we can get out of SAP with regards to accounting. So the difference between financial accounting and management accounting is that financial accounting is done or used more for external purposes. So we need to provide regulatory reports for a public company. So things like balance sheets, income statements, cash flow statements need to be provided for external purposes. And financial accounting is recording the financial impacts of all the processes, so debiting and crediting all accounts. Financial accounting is the heart of accounting because it has to accurately reflect the financial status of a company or firm at any given point. Management accounting is done for more of an internal purpose. It provides information to the organization so they can make decisions, so create budgets, make buy decisions, sourcing decisions, those sorts of things, hiring and firing decisions. Management accounting, or it's sometimes called controlling, focuses on costs and revenues. So we always want to be looking at ways to lower costs and increase revenues. And, we take the information from financial accounting to make these managerial accounting decisions. So now we're going to move on to the data we need set up in SAP before we start doing these accounting processes. If you remember from last week, there's 3 types of data: organizational data, master data, and transactional data. So we need to make sure the client code is set up in SAP, and the client code is the highest organizational level. So it's the enterprise level. So if you're Procter & Gamble or General Motors, it's the highest level. We also need to set up the company code. So companies that have different enterprises that have different companies within them, we need to make sure they're set up. And this is usually where accounting is done and financial statements are made at this area. You'll also want to set up business areas. And business areas are internal divisions of an enterprise. And you may want to do reports based on product lines or geographical areas. So you need to set that up to be able to do financial reporting on those areas. So we also need to set up master data as well. So if you remember last week, we talked about one of the most common or most important master data we need to set up is the material master. Well, to do the accounting processes, we need to set up all of our accounts in SAP. So here's a whole bunch of accounts we'll be looking at setting up so that we can record all the financial impacts of all the processes we're doing. Parallel accounting is maybe a term you've heard of. So many times companies use multiple ledgers or different books for different purposes. So usually they have one leading ledger for all company codes. And this is done for global principals are consolidated into these leading ledgers, and all transactions are posted to the leading ledger. But a company may also have non-leading ledgers for each company code. And you may have these different books for local accounting processes and practices or for local reporting. So general ledger accounts are what we need to set up in our master data, and it records all accounting relevant business transactions. And so we record them all at the general ledger account. The data in the general ledger accounts are segmented by organizational level. So the general ledger has chart of accounts data and company code data. So here's all the accounts we need to set up on our general ledger. So we need to set up all our balance sheet accounts. So the balance sheet shows what the company owes and what the company owns. So it includes assets, what they own, liabilities, what they owe, and owner's equity, so the owner's share of the company assets. So we need to set up all these individual accounts in our master data. We also need to set up income statement or profit and loss statement accounts. So this includes the revenues. So this is the money the company earns by selling products and services. And we need to set up all these expense accounts, and expense accounts are costs associated with making and selling products and services. So one thing you have to keep in mind, on the general ledger, we don't have an account for every customer and every vendor and every asset. So we usually have a reconciliation account on the general ledger, and then you have a sub-ledger that has accounts for each customer, vendor, and asset. So now let's take a look at the individual accounting processes. We're going to look at general ledger accounting, accounts payable accounting, accounts receivable accounting, and asset accounting. So general ledger accounting is concerned with recording the financial impact of all process steps performed in the organization. So buying, making, selling, material planning, project management, we control that on our general ledger. And we do double entry accounting for every transaction. And on the general ledger, we have all the accounts divided into the balance sheet accounts and income statement accounts. So again, double entry accounting. For every debit, there's a credit. So here's an example of general ledger accounting. If a venture capitalist is investing $50,000 in GBI, that $50,000 goes into their bank account. We debit the bank account and we credit the common stock account. Here's an example of general ledger accounting if Global Bikes buys supplies with cash. So we credit the bank account because the cash comes out, and we would debit the supplies expense account because our supplies expense goes up. Here's an example if we buy supplies on credit. So the first step is we buy the supplies, so we debit our supplies account and we credit the accounts payable account. Step 2 would be we make payments, so the money would be credited from our bank account and debited to our accounts payable account. So the other type of accounting, one of the other types of accounting is accounts payable accounting, and this has to do with the procurement process. So again, we wouldn't have an account for every supplier on our general ledger. We would have sub-ledgers to track the money owed to each individual vendor, and then we would have a reconciliation account, an accounts payable reconciliation account on the general ledger. So we need to set up a vendor master in our master data to be able to have each vendor account and the reconciliation account. So here's just an example of accounts payable accounting. So if we buy material from 3 different vendors, the first step would be to buy from vendor 1, vendor 2, and vendor 3, and we would credit the accounts payable on the sub-ledger. We would reconcile it onto the accounts payable reconciliation account on the general ledger. So that's buying it from the vendors. This next step would be to pay the vendor. So the money would come out of our account. We would debit each accounts payable sub-ledger account and the accounts payable reconciliation account. So the third type of accounting is accounts receivable accounting, and this has to do with selling or the fulfillment process. And again, we would not have every customer on our general ledger. We would have one reconciliation account, the accounts receivable reconciliation account on the general ledger, and then we would have a sub-ledger that would have each customer on it. So again, we would need to make sure the customer master data is set up to be able to do this. So again, an example of accounts receivable accounting, if we sell bikes to 2 customers, so step 1 would be the sale to the customer. So we would debit the accounts receivable account for each customer, and we would credit our sales revenue to our sales revenue general ledger account. The next step would be the payment from the customer. So when we receive the payment from the customer, we would debit our bank account and we would credit the accounts receivable sub-ledger account for each customer, and we would reconcile that on the accounts receivable reconciliation account. So the next type is asset accounting. So assets are things like buildings, equipment, those sorts of things, and asset accounting is concerned with the tracking of the financial consequences with the entire life cycle of an asset, from acquisition to depreciation to retirement. So we need to keep track of these, and again, we wouldn't have each asset on the general ledger, so we would have a reconciliation account for our assets on our general ledger, and then we would have a sub-ledger for each type of asset. So an example of asset accounting, so if we bought a desktop computer, we would debit the desktop computer sub-ledger, asset sub-ledger, and we would debit the office equipment and computers reconciliation account on the general ledger. So that would be purchasing the computer. And we would credit our asset acquisition clearing account. Step 2, we receive an invoice from our supplier. So step 2, we would credit our accounts payable account, and we would debit our asset acquisition clearing account. And step 3, we would make payment. So we would debit our bank account, we would debit the accounts payable account, and that would be the asset accounting process. So another important part, we've talked about financial accounting, then there's also the management accounting or controlling process. So this talks about managing and allocating costs. So most of the data used in management accounting comes from financial accounting. So companies carry out different processes, and they need to keep track of this money so they can figure out if they're making money or losing money, or how much things are costing them. So we do this by creating cost centers. So we need to set up cost centers in the master data. And cost centers are locations where costs are incurred. So they're like buckets. So we can charge the different departments, people, equipment, to these different cost centers so we can figure out what things are costing us. And commonly you'll hear of work orders, and that's used to keep track of what different things or processes are costing us. So here's just showing an example of management accounting. So if we buy supplies, we would debit the supplies expense, and we would charge it to a cost center. And then after charging it to a cost center, we would divide it up into different departments as to who may be using those supplies. Here's an example of utilities. So if we have electricity and water, again, it would go into a cost center, and we would allocate them to different cost buckets. So in management accounting, right, we need to have that information to figure out how much things are costing us so we can make decisions such as buying, making, hiring, firing, that sort of thing. So another thing to keep in mind is, again, financial accounting interacts with all the different types of processes. So buying, right, we keep track of what we owe our suppliers. Making, controlling the cost exchanges and the controlling and cost centers. Fulfillment, which is selling, right, we have to keep track of what our customers owe us. Our asset management, so our assets cost money and they depreciate. Management accounting, again, we use information from financial accounting to make managerial decisions. Inventory and warehouse management, we need that to be able to figure out how much things are costing us. Project management, we need equipment and people, so that involves financial accounting as well. So the last thing I want to talk about is reporting. So that's a great thing about enterprise systems, is we can, get great reports. So we can display account information, and we can also generate financial statements. So here's an example. In SAP, we could generate a balance sheet. So, because we're keeping track of all of our expenses and all our processes. Another thing you could generate is a profit and loss or income statement from SAP, from everything that's been going on. There's also other, you could do a list of accounts, a whole bunch of other reports. So that's